Hello and welcome. In the previous video, I explained you what an index is. Correct? In this video, we will learn why the stock market indices are important to investors like us. Alright? Now, what is a stock market index? In simple terms, an index is a collection of stocks that are grouped together to track the overall performance of a specific section of the stock market. Correct? Think of it like a report card. Instead of grading just one company, an index grades a whole group of companies, providing an average score. Different indices track different groups of stocks and they act as benchmarks. Now, this helps investors like us to gauge how well the market or a particular sector is performing. Alright. Some indices track large, well established companies, while others focus on small or rapidly growing businesses. Okay. Some look at specific sectors like information technology or banking, and others give us a broader view of the entire market. Now, let us take the examples of Nifty 50 and Sensex itself. We will learn more about these indices. Alright. The Nifty 50 is made up of 50 of the largest and most actively traded companies listed on the NSE. What is NSE? National Stock Exchange. What is it? It is a shop, correct? It is a shop from where we buy stocks from. Well, shop is just an analogy. Okay. Now, this is about Nifty 50. The Sensex is composed of 30 large, well established companies on the Bombay Stock Exchange or the BSE. These are often called blue chip stocks because they are considered reliable, financially sound companies. When people say the market is up today, they are often talking about the Nifty 50 or the Sensex. They are considered leaders for the overall health of the Indian economy because they include a wide range of industries from giants like Reliance Industries and HDFC Bank. They also have IT leaders like TCS. Okay. Now these indices, meaning both Nifty 50 and Sensex, are what is known as market cap weighted indices. Now, I have not taught you about market capitalization. I will teach you about it in a later lesson. Okay? But for now, just know that both Nifty 50 and Sensex are market cap weighted indices. This means that companies with the largest market value, specifically their free float market capitalization have the biggest influence on the index's overall performance. Meaning, a big swing in Reliance's stock price, for example, can have a significant impact on the Nifty 50 or Sensex. Okay? Next, let us talk about an index focused on one of India's most powerful sectors, the Nifty IT Index. This index is best known for tracking the performance of Indian IT companies. Okay? This index includes major players that are famous globally, such as TCS, Infosys, and Wipro. So, if you are interested in how the Indian tech industry is performing, then the Nifty IT index is what you have to track or watch. Okay. Now, this index can be more volatile than the broader Nifty 50 or Sensex. This is because technology stocks can swing up and also down more dramatically. The Nifty IT is also a market cap weighted index, meaning the biggest IT companies have the most influence on its performance. Alright. Now, you may have a question. What if you want to track smaller businesses and not the bigger ones? Are there any indices that track smaller businesses? Yes. Now let us talk about it. The Nifty Small Cap 250. This is an index that tracks 250 small cap companies. These are the companies that are still in their growth phase and have smaller market capitalizations. Alright. Investing in small cap stocks can be riskier, but it can also offer higher rewards, meaning returns. This is because smaller companies have more room to grow, but they are also more vulnerable to economic downturns. The performance of small cap stocks is often seen as a sign for the health of the domestic economy. When the small companies are doing well, it is often a good sign that economic growth is picking up. Alright. Now comes the main question. Why do indices matter? Why are they important? They are important because they serve as benchmarks. Investors use them to see how their own portfolios are performing compared to the broader market. Meaning, if the Nifty 50 is up 10% this year and our portfolio is up only by 5%, it means we are doing something wrong. We may have to rethink our investing strategy. Alright. Next, many investment funds like index funds and exchange traded funds, also called as ETFs. Mind you that we have not learnt about these. We will learn about these slowly. Okay. But many index funds like or many investment funds like index funds and ETFs are built around the indices. So instead of picking individual stocks, investors can simply buy the units of an index fund that mirrors the performance of a specific index, like the Sensex or the Nifty 50. Now, this provides an easy way to diversify your portfolio across many companies with a single investment. Okay. Finally, indices give us a snapshot of the overall economy, meaning when the Nifty 50 or the Sensex is climbing, meaning going up, it usually signals economic growth and investor optimism. When they fall, it can indicate economic trouble or a market correction, we call it as. Okay. So by tracking stock market indices, we can get a quick view of how well the market and often the economy is doing. Okay. Whether you are looking to measure your portfolio's performance, invest in index funds, or keep a finger on the pulse of the market, understanding these indices is crucial. Alright, they are not just numbers, they are really the heartbeat of the stock market. Alright, so I hope you have understood why indices matter.